Anant Shirgaonkar, head of India at UBS as well, is on board with us. Anant, morning, and would you concur with Chris Wood's view that if you're betting on the commodity cycle, there's only one market that's favoring right now, and that's India?
Yeah, so we are overweight on India at these levels, and we are overweight on China as well. So to that extent, I guess in the emerging market space or in the Asian space, I think India would perform well. So I think that's our view as well.
China, does the correction right now does not bother you, or do you think there are significant gains and we would get back to the peak that China was about 3 months back?
No, so I think on the correction front, I guess our view is slightly different from most participants in the market. So we believe that 8600 is a fair value for Nifty as we go towards December 2015. That's our target for the year end, and we believe therefore that the market may not have a lot of upside in the immediate term till the time the earnings sort of sort themselves out. So over here, I guess we will have to show a lot of patience. For a 12 to 18 month view, I guess the market would show upside, but in the immediate future, I guess the market would remain choppy and volatile simply because of the earnings being tepid.
Anant, good morning, Neeraj here. What leads the earning upcycle whenever it comes, say Q3 or Q4? Because I mean, I'm just looking at spaces aside of IT. There is almost nothing that has impressed me on the upside. Pharma, which was the best performer, also has now dark clouds for the rest of the year. What will lead this earnings uptick in Q3 or Q4 as the case may be?
No, so I think the earnings upside may not come in F16. So our view for the big earnings upside is possibly after that. So for F16, we are talking about a 10% earnings growth for Nifty on a top-down level. The next year, we're talking about 18%. But before that, we will have to contend with the remaining 3 quarters of this year. And the scenario over there doesn't look too encouraging, especially because the rest of the street or the consensus is still hovering around 15-17% for Nifty earnings growth. So what we believe is after this quarter's earnings, over the next 1 or 2 quarters, we would actually start seeing the consensus sort of taper down their earnings growth projections and come closer to the 10% level. And that's exactly the reason why we believe in a scenario wherein the earnings overall on the street are getting downgraded. The market may not have a lot of upside, so we will remain sort of range bound or choppy at these levels. Beyond that, I think as we look towards F17, F18, we would start seeing the earnings growth pick up, and that's mainly based on the cyclical recovery that we're all hopeful of. So I think that's how the big picture should pan out for India.
Okay, but tell me, Anand, you don't believe that the capex related sectors and the government capex related sectors could actually make a move in Q3 and Q4? Because if we speak to people in Delhi, in the ministries as well, a lot of them believe that Q2, the government spend will kickstart in a rather big way, and that will have an impact on some of these domestic cyclicals which are linked to the government spend on infrastructure, so on and so forth. You don't think that will move the needle?
No, so I think we are hopeful that the government spend increases, and we believe that that is the way to sort of kickstart the upcycle. The first sort of round of spending will have to come from the government, and when the economy sort of shows signs of recovering, that's where the private investments would start flowing in. So that scenario is fine. But on the earnings front, there are 2 points to note. One is even if the government spend starts off, it will take a while for these companies to start reflecting that into the earnings. And secondly, if you look at the Sensex or the Nifty, I don't think Nifty is sort of exposed too much to the companies which would benefit straight away from government spend. So to that extent, I think the Nifty earnings growth or the Sensex earnings growth may still remain tepid for this year.
And where do you think maximum pressure is going to come in from, Anant? Would it continue to be metals because of this commodity downturn and the China impact? Do you think this sector is going to be, is going to continue to be most weighed?
Yeah, so I think we are not positive on metals on a whole. We're positive on top-down ideas in metals, particularly in, say, steel. But beyond that, I guess there could be earnings downsides coming in on some of the financials, wherein there could be more credit costs which may come through. Secondly, I think IT services is a sector in which we believe that we are far more negative than the rest of the street, and we think there's a case for earnings downgrades on that front. consumer discretionary, especially in terms of the two-wheeler segment, I think that there could be some downside there. Overall, consumers could actually see some earnings downsides because of the rural economy not firing as much as it was firing in the last 3 to 5 years. So I think there are pockets in which there is scope for earnings downgrades.
So is it safe to assume that it's the PSBs that you're talking about when you talk about financials and in particular banks?
Public sector banks, I guess, have anyway underperformed the market, but I guess that's where most of the pain could be in terms of asset quality. That has been sort of factored in partially by the markets, but I think it may not be completely into the numbers. And beyond that, I think we believe that NBFCs or some private banks also may see some earnings downgrade, simply because we've seen a case of euphoria in which the earnings sort of ran ahead of the fundamentals. So I think there is scope for earnings downgrades on that front as well.
Interesting. Anant, couple of fund managers who would probably be your clients as well, and a conversation that we were having with them, they were of the opinion that it might, for a really long-term investor, it might not be a bad idea to look at the metal space just because of the wealth destruction that has happened there. And yes, we know that the commodities are in a bit of a down cycle, but over a 3-year period, there is a high probability that these will reverse as well. And therefore, the well-managed metal names, which are not too heavily indebted, I mean, there are likes of NMDC, etc., might actually not be a bad idea to look at right now for the patient investor. Is that a theme even worth looking at, or is it just so uncertain that you avoid it for the time being?
No, it's absolutely a theme worth looking at, and we are positive on certain top-down, bottom-up ideas in the steel sector, for example, wherein I mean we have the view that metal prices may not help a lot in the next one year or so, but individually bottom-up ideas, we're seeing volume growth which might start kicking in simply because of the projects which might near completion. So if you do some work on bottom-up ideas in which volume growth may sort of offset the price damage, then I guess there is a chance for those stocks to start doing well. And remember, metals are like deep cyclical, so the 2 to 3 year view, we will start seeing recovery coming in over there overall.
Okay, the other question that I have is on the high priced consumption names. It's the other end of the spectrum completely, but the likes of Page Industries, Eicher Motors, Bosch, not strictly a consumption theme, but what I'm trying to get you is as that these are stocks which are high quality companies, good return ratios, etc., so on and so forth, but the pricing, the valuations are extremely high. Do you think these high valuations will stay for these companies, or could there be a bit of a tapering down because of what you said, that the next 3 quarters will not have earnings growth as large, and therefore the markets could well be tempered as well?
So we are overall not very positive on consumer staples, for example, or consumer discretionaries, which are very highly valued and expensive. One of the reasons is that these consumption names actually did well because we had rural demand and urban demand sort of fire well in the last 3-4 years. There was also a situation wherein there weren't enough investable options in the rest of the market, and therefore most institutional players sort of flocked to these consumer names, and therefore it led to valuations getting stretched. Now we are in a situation wherein I think rural may not fire as much simply because of the government impetus not being as strong as it was during the previous government. And under that scenario, we will probably see volume growth for some of these consumer names sort of lag, and that may have an impact on top line as well as on the bottom line. So on and all, on the portfolio basis, we are not very positive on consumption, especially on names in which the earnings may be tepid and the valuations are still stretched.
Anant, I just want to scratch the point that you were making earlier, that IT as well is one pocket where you do foresee some downgrades coming in. Now, there are some contrarian views in the market that do believe that, like Infy, there would be many other dark horses within the IT pack. But you don't believe that there could be anything which could look strong, mid caps or large caps?
So most of the coverage that we have in IT is tilted towards large caps. So there could be mid cap ideas or individual ideas in which there could be stocks or companies which may show an upswing in terms of earnings. But overall, our view on IT is that IT spends are under pressure globally, and even Gartner's come out with a report which talks about IT spends and budgets being under pressure, especially for IT services. And under that scenario, we think that the demand for IT services may be under pressure. Plus, we have a situation in which the digitalization which is playing out is sort of changing the model for our IT names, and I think that is a growing component which is growing extremely fast. So we think that one, the budgets being under constraint, and secondly, there is a transitionary phase which our IT services companies are going through. Both put together, I think there would be some pressure on margins and therefore some pressure on earnings.
How big a panic creator, Anant, is this entire P-note issue? Or do you think voices coming in from New Delhi trying to soothe the market nerves that it's not going to be disastrous, the government is going to take cognizance of market participants and what the participants are really in for, and it's not going to be an extremely disastrous step? Do you think that was enough?
So we've seen this P-note scare come quite a few times in the past as well, and the government is well aware of the issue. We've seen the finance minister come out yesterday, talk about how the government is going to apply its mind and see what we need to do about the issue. So I think we shouldn't try to preempt the scare for now. I don't see that sense of panic when I talk to institutional clients either. So to that extent, I guess I don't think that's an immediate worry for the markets.
Right, Anand, so just before I thank you, actually just a follow-up. So you don't believe that this scare that we're having the last yesterday's session essentially was because of P-notes at all? You are saying that your clients are sounding completely unperturbed because of all this noise.
So I wouldn't associate a lot of that to P-notes, but I guess it's more to do with the earnings season and the numbers, the way they may get tempered down over the next 1 or 2 quarters. So I think that is a readjustment phase in which we are in, and that therefore the volatility is probably here to stay.
And monsoon, and probably the fact that the monsoon session of the parliament isn't turning out that well to GST so much. But Anand, thank you so much for taking the time out and joining us today and giving us your thoughts. Really good having you, Anand. Look forward to having you more often.
Thank you very much.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.